Ever wondered how option trading works? Well, today we're diving into the intriguing world of options. Picture this. Options are like tickets to a concert. You purchase the ticket, giving you the right, but not the obligation to attend the concert. In the same vein, options are contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a specified price before a certain date. Imagine you're eyeing a piece of land. You have the option to buy it at a certain price within a specified period. If the land's value skyrockets, you're in luck. You can buy it at the agreed price and make a profit. But if the value plummets, you can simply let your option expire and walk away, limiting your loss to the cost of the option. Options trading may seem complicated, but it's like learning a new game. Once you understand the rules, you can play and maybe even win. Now that we know what options are, let's delve into how they work. Imagine you're about to buy a new car, but you're worried about the price going up before you can seal the deal. So you talk to the dealer and pay a small fee to lock in the current price for a certain period. Now, if the price increases, you still get to buy at the agreed price. If it doesn't, you lose the fee, but no more. That's essentially how options work. They're contracts that give you the right to buy or sell an asset, like stocks, at a set price within a specific time frame. The fee you pay is known as the premium. Now, there are two key roles in an options contract: the buyer and the seller. The buyer of an option pays the premium and acquires the right to buy or sell the underlying asset. On the other hand, the seller, also known as the writer, receives the premium and is obligated to sell or buy the asset if the buyer chooses to exercise the option. Let's break it down further. When you buy an option, you're not obligated to buy or sell the asset. You have the choice. That's why it's called an option. But if you're selling an option, you're obligated to fulfill the contract if the buyer exercises their right. It's like the car dealer in our analogy. They receive a fee and are obligated to sell you the car at the agreed price if you choose to buy. But if you don't, they keep the fee and sell the car to someone else. Remember, options can be complex. They're not just about predicting whether prices will go up or down. They involve understanding market volatility, time decay, and more. But once you get the hang of it, options can be a powerful tool in your trading arsenal. Think of options like an insurance policy. You're paying a premium for potential protection or profit. In the options market, there are two main players, calls and puts. But what do these terms mean? Imagine a bustling marketplace filled with buyers and sellers. In the world of options, these buyers and sellers trade in two main commodities: call options and put options. So let's take a closer look at these two players. First up, we have call options. Picture this. You're an investor and you're eyeing a stock. Let's call it Tech Titan. You believe that Tech Titan's price is going to rise in the future, but you don't want to buy the stock outright today. Instead, you purchase a call option, giving you the right, but not the obligation, to buy Tech Titan at a predetermined price, known as the strike price, within a specific time frame. Now let's say Tech Titan's stock price skyrockets, just as you predicted. You can exercise your call option and buy the stock at the lower strike price, then sell it at the current higher price, pocketing the difference. But if Tech Titan's stock price falls, you can simply let the option expire, limiting your loss to the premium you paid for the option. Next, we have put options. Picture the reverse scenario. You believe that Tech Titan's price is going to fall. To protect yourself, you buy a put option, giving you the right to sell Tech Titan at the strike price within a specific time frame. If the stock price plummets, you can exercise your put option, selling the stock at the higher strike price and then buying it back at the lower market price. Conversely, if Tech Titan's price rises, you can let the option expire, and your loss is again limited to the premium paid. In essence, a call option is a bet that a stock's price will rise, while a put option is a bet that it will fall. Both types of options provide a way to capitalize on price movements without having to own the underlying stock. So, calls and puts are like two sides of a coin, each with its own purpose and strategy. Now you might be thinking, how can I use options to potentially make a profit? Let's dive into some basic strategies for trading options. First up, buying calls. Imagine you're eyeing a sleek new smartphone, but you're waiting for a price drop. Buying a call option is similar. You're betting that a stock's price will increase. If it does, you can buy the stock at a lower price and sell it at the current market price, pocketing the difference. And if the price doesn't rise, well, you only lose the premium you paid for the call option. Next, we have buying puts. Think of it as insurance. If you own a stock and fear its price might tumble, buying a put option gives you the right to sell the stock at a predetermined price, thus limiting your potential losses. It's like having an umbrella ready for a rainy day. Then there's selling covered calls, a strategy often employed by stockholders. Let's say you own a stock and sell a call option for it. If the stock's price stays under the strike price, you keep the premium from selling the call and still hold on to your stock. It's a bit like renting out your apartment while still owning it. Finally, we have selling puts. This is a bet that a stock's price will stay the same or increase. If the stock's price remains above the strike price, you keep the premium from selling the put. But if the price drops, you might have to buy the stock at a higher price. It's a bit like a dare. You're wagering that you won't get splashed by a puddle. Each of these strategies is a different tool in your trading toolbox. Just like a hammer isn't the right tool for every job, each strategy isn't right for every situation. It's about understanding the market, assessing risks, and making informed decisions. Remember, each strategy has its risks and rewards. It's all about finding the right balance for your financial goals. Options trading is not a guaranteed path to wealth. It comes with its fair share of risks and rewards. Just like a double-edged sword, options trading can both magnify your profits and intensify your losses. The reward? Well, options offer the potential for significant returns, often in a short time frame. They allow you to control large amounts of stock for a fraction of the cost. Now the risk? You could lose your entire investment. Options are perishable assets, meaning they have an expiration date. If the market doesn't move in your favor before that date, you can wave goodbye to your investment. Moreover, options trading can be complex, requiring a good understanding of the market and the ability to react quickly to changing conditions. It's not for the faint of heart or the uninformed. Options trading can be rewarding, but it's not without risk. Always do your homework before diving in. So, we've embarked on a whirlwind tour of the world of options trading. We've peeled back the layers of this complex yet fascinating aspect of the financial market, exposing its many nuances in a simple and easy-to-understand manner. We began by exploring what options are and how they function, shedding light on the intricate dance of calls and puts. From there, we delved into the basic strategies that traders employ, providing a glimpse into the tactics and techniques of the trade. We didn't shy away from addressing the risks and rewards inherent in options trading, balancing the allure of potential profits with the stark reality of potential losses. To bring these concepts to life, we painted scenes from the real world, helping to cement these abstract ideas in tangible examples. Remember, the world of options trading is vast and intriguing. It's a game where knowledge is power, so keep learning, keep exploring, and who knows, you might just hit the jackpot.